So you've been probably watching the news lately and realizing that the Federal Reserve is raising interest rates and everybody's freaking out. And you probably ask yourself, why the hell should I care and how does this affect me? Well, you come to the right place. My name is Debt Free Joel, and on today's personal finance tip, we're going to talk about why you should care that the Federal Reserve is raising interest rates. If you like these type of videos, cool, click the like and subscribe button and let's get to it. So should you care about the Federal Reserve raising interest rates? Well, yeah, you should. Here's the thing. When the Federal Reserve raises interest rates, the first thing I want you guys to think about is that the cost of borrowing goes up. So there's a lot of companies out there that peg the interest rates that they charge you, the consumer, or they charge businesses, for example, on interest rates, on debt that they're going to have. So what happens is that the Federal Reserve, when they raise interest rates, means that companies like your credit card company, looking to buy a car, looking to buy a house, your mortgage interest rates, all of those increase at the same time. So why should you care? Well, the obvious is that if the cost of borrowing is going to increase, your spending is going to decrease, right? So think about it. If you want to go buy a house right now, what you've probably been seeing is that people don't want to buy a house because interest rates are starting to rise. If you think about looking for a car right now, trying to finance a car, the interest that is going to be charged by the bank is rising. When you look at just your general credit card, what you're going to see that your credit card, when they charge you an interest, it's a variable rate interest, which means when the Federal Reserve raises interest rates, guess what happens to your balance? It's going to increase on your credit card because the interest rate that they charge you is going to increase. That's why you should care. But it gets deeper than that. You see, when interest rates rise, the reason why the Federal Reserve is doing this is to bring down inflation. Inflation is caused by you, the consumer, buying a bunch of things that you probably don't need. Well, if you can't buy a house, if you can't buy a car, if you can't go and spend your money the way you would like to because you're paying too much on your credit card bills, your spending comes down. When your spending comes down, inflation comes down because inflation is directly tied to the spending of the economy. Think about it this way. If there was one loaf of bread in your neighborhood right now, how much would it cost? Because everybody would be trying to put money on it. But when spending comes down and demand comes down, the price for those goods are going to come down. That's what happens with inflation. Now, why do you care even more than that? How does it relate to the stock market? Well, if I'm a company, I give you sales projections. I basically say that I'm going to be selling, for example, a certain amount of iPhones for the rest of the year. Well, if your spending comes down because the cost of your borrowing is going up and you're trying to cut back because inflation is too high, what's going to happen is that you're going to reduce your spending. Me as a company, i.e. Apple, that means that my sales projections are going to miss. My earnings per share are going to miss, which means that investors are looking at their stock saying, this stock is overvalued based on what the market conditions are right now if the Federal Reserve raises interest rates. This is why you're seeing stocks drop. Now, why do you care about the cause of recession? Here's the big thing. When the Federal Reserve raises interest rates, it decreases your spending, like we talked about. When you decrease your spending, economic activity starts to pull back. But if it pulls back too sharply, you have a recession because companies are no longer going to be able to sustain the employee base that they have, the sales projections that they have, the revenue forecast that they have. And remember, because the Federal Reserve, when they raise interest rates, those interest rates are tied to what banks will charge you for loans. When a company wants to borrow debt, it gets much more expensive to finance things that they want to do. When all of that happens and it happens too fast, there's a contraction on the economy. Think of your general, domestic product or GDP, for example. When that starts to slow and it slows for consecutive months, this is what's labeled as a recession. When a recession happens, what happens? People cut back on spending even more, companies lay people off, and the stock market starts to drop. So this is why you should care about the Federal Reserve raising interest rates. It's because the cost of spending, right, the cost of borrowing goes up. When the cost of borrowing goes up, you as the consumer stop buying stuff. When you stop buying stuff, inflation comes down. But if you stop buying stuff too quickly and too harshly, which happens a lot, this can cause a trigger for a recession. This is why 60% of CFOs and CEOs right now are saying that there's going to be a recession within the next 12 to 18 months because people are tied to their money in an emotional aspect. So when people start cutting back, they really cut back. Think of a pendulum, right? Think of how a pendulum just swings, right? So right now we went from spending way too much and people are going to swing and correct too hard. And now it's going to get to the point where people are not spending any money, no economic activity, recession. Got it? Good. Well, that's my personal finance tip for today. Understand what happens when the Federal Reserve raises interest rates. I'm debt-free Joel. Hopefully you like these type of videos. Cool. If you do, click the like and subscribe button. Feel free to send this to anybody you think will be helpful. Feel free to follow me on Instagram at debt-free-Joel. It's the same name. We talk about everything finance, from saving, investing, and most importantly, charity. Until next time, keep your money up.